Capital is very important in doing our capital budgeting decisions, whether we're using a net present value calculation, where we discount future cash flows at the cost of capital, or whether we're doing an internal rate of return calculation and comparing that internal rate of return to our cost of capital. Our cost of capital and its calculation are crucial in making our capital budgeting decisions. Now, sometimes we won't use exactly our firm's cost of capital, because if we're evaluating a project that's more risky or less risky than our firm's average project, then we should use a higher or lower cost of capital to adjust for that. And we'll talk a little bit about that too. But let's look at this calculation of our cost of capital. And remember, in our capital budgeting decisions, we used after-tax cash flows. So we need an after-tax cost of capital to the firm. Well, let's just define this weighted average cost of capital. It's the overall opportunity cost of the firm's capital. It's a weighted average of the opportunity costs of debt, preferred equity, and common equity. Remember, the whole idea here is that we want to purchase assets that give us a higher return on our investment than the funds cost us to undertake that project. That's how firms create wealth. So for any firm, its capital structure, some percent debt, some percent preferred stock, and some percent of the capital raised by issuing common equity. So a project should only be undertaken if the return on invested capital is greater than its opportunity cost. And the opportunity cost is not paying back our sources of capital, or at least that's one way to interpret it. So here's some of the symbols we'll be using. KD is cost of debt. KD times 1 minus the tax rate, that's the after-tax cost of debt, because the interest payments on debt are tax deductible. Now, dividend payments on preferred stock and common stock are not tax deductible. There's no tax implications of that. It's simply a return of money to the equity owners. So KPS, that's our cost of preferred stock, and KCE, our cost of common equity. So these are going to be our components of our weighted average cost of capital. Well, what are the weights? Well, the weights are the percentage of the total market values of all the firm's securities outstanding for each one. So the percentage of the capital of the firm, the percentage of the market values of debt, preferred stock, and common equity are going to be our weights. And when we're calculating the average cost of capital, we usually use some target weights. So in this example, we refer to firm X's target capital structure. 10% preferred stock, 45% debt, 45% common equity. We're told that the cost of debt, and that would be the current yield to maturity on newly issued debt by this firm, 7.5%. The tax rate for the firm, its marginal tax rate is 40%. The cost of preferred stock is 9%. And the cost to the firm of issuing common stock, the return of 11.5%. So to figure our weighted average cost of capital, 45% times the, let me get my pen here, this is our after-tax cost of debt right here. So 45% debt, 45% common stock, well, there's that times the cost of common stock, and then 10% times our 9% cost of preferred. So that weighted average comes out to 8.1%. So now we need to talk a little bit about where we come up with these numbers, but the idea is pretty straightforward. Your overall cost of capital is based on the cost of each source of capital and how much of your capital is raised from each source. So how do we determine that target capital structure? Well, one way is to just use the firm's existing capital structure weights. But remember, these are not from the balance sheet. These weights should be based on market values. Take the market value of the debt outstanding, add it to the total market value of any preferred stock outstanding, add that to the total value of any common stock outstanding, and then take the proportions of each one. But we can also adjust these for firm trends. If a firm has been paying down its debt every year for the last few years and from all indications intends to keep doing that, then maybe the target capital structure will have less debt than the current capital structure. Or we could use industry average weights. The idea being that firms tend to move toward the industry average over time. One reason these get a little out of proportion is in any given year, a firm probably won't issue all three kinds. They probably won't issue preferred and common and debt. Might be more economic to do debt one year and common stock another year. So in that case, maybe use the industry average because we think our firm is kind of bouncing around that industry average from year to year. Remember that changes in the value of the common stock and the value of the debt are also going to affect these weights. Now the marginal cost of capital is simply the weighted average cost of capital for an additional dollar. Whenever we talk about marginal, we're talking about for one additional dollar or one additional unit. So a firm's marginal cost of capital increases as the firm increases the amount of capital it raises during a given period. So the more debt and more equity you raise in a given time period, like a year, the higher your cost of capital. So that's why we say the marginal cost of capital is going up with larger capital budgets, larger amounts of total investment. So we've got an upward sloping marginal cost of capital line. We've got a lot of projects out there, and we can rank those projects by their returns, right, by their internal rates of return, and just accept those where the return is higher than the cost of capital, those that have a positive net present value. So we can draw an investment opportunity schedule based on our analysis of potential projects, and then we can draw our marginal cost of capital by figuring out how high is our weighted average cost of capital and how does it increase as we raise larger amounts of money per time period. So just to illustrate the concepts, we've drawn it like this. We've got an upward sloping marginal cost of capital schedule. We've got a downward sloping, we're looking at project IRRs now, downward sloping investment opportunity schedule. Our cost of capital is measured over here, our marginal cost of capital. And where they intersect, this is how much new capital we should invest this year, or how much capital we should invest this year in new projects. Because for every project to the left of this, the IRR is greater than the weighted average cost of capital. So that means it's a wealth increasing project. It has a positive net present value. Here, where those two cross, we go to zero net present value projects, and anything to the right of this would actually be value destroying, because the marginal cost of capital for a budget of that size is greater than the internal rate of return on the additional projects we have to do. So using these arguments, we come to this idea of an optimal capital budget. The choice and funding of capital projects that will increase the value of the firm the most of any bundle of projects. So this kind of summarizes, I think, what we've already said. The weighted average cost of capital is the appropriate discount rate for projects that have same level of risk or similar risk to the firm's existing projects. A project with greater than average risk should use a greater discount rate to account for that risk. And for projects with below average risk, use a discount rate that's less than the firm's weighted average cost of capital. So these calculations, very straightforward. Pre-tax cost of debt times 1 minus the tax rate. Firm can issue new par debt with a yield to maturity of 7.5, faces a 40% tax rate, 7.5, 1 minus the tax rate, 4.5%. That's our after-tax cost of debt. Now, when available, we should use the market rate of interest, the yield to maturity on the firm's current debt, not when it was issued, but now in the marketplace. Since it was issued, the firm's credit standing could have changed, overall market interest rates could have changed, the spreads between treasuries and debt of this risk class could have changed. So we want to look at the current market rates. Now, if the firm's debt isn't publicly traded, but we could get a rating on it, we could say, well, they're going to issue, we think, 15-year debt is what they do. They're a double B rated company. Let's look at the 15-year double B yield curve, or look at the yield curve for double B debt at 15 years and use that as the required yield to maturity for that debt. Now, some firms primarily use floating rate debt, right? Reset once every year. Well, that's typically lower than longer maturity debt. When the yield curve is upward sloping, it's certainly lower. Well, the suggestion here is that you use the current yield curve in the firm's debt rating. Reason being, over time, if you reinvest and have to change, not reinvest, I guess in this case, reborrow at various rates from year to year to year, the pure expectations theory tells us that the rate on a 10-year bond approximates the average of the 1-year rates over that 10-year period. So if a firm's issuing 10 or 15-year floating rate debt, just use the firm's debt rating and that maturity to get a yield to maturity from the market, rather than using the lower floating rate. Cost of preferred stock, simply the dividend over the market price. If we've got a preferred stock valued at $100 a share, paying a dividend of $8.50, that's an 8.5% yield. We don't expect any appreciation in the price of the preferred stock. It may fluctuate with interest rates, may fluctuate a little bit with the creditworthiness of the company, but in general, if things go well, it's going to stay right at 100 in this interest rate environment. So in the current interest rate environment, our cost of preferred stock here, 8.5%, no adjustment for taxes. Now, the cost of common equity, a little tougher than either of the two we've just done, and we're going to look at 3 methods here. Our first method is to use the capital asset pricing model. If you're not familiar with this, it's explained a lot in the study session on portfolio theory and management. But the CAPM basically says that the required rate of return on equity is the risk-free rate plus a premium for the stock's market or systematic risk. And that's what we measure by beta. Now, how would you know on the exam when you're supposed to use this method? Well, if you're given the risk-free rate and a beta and the market risk premium here, or the expected return on the market, then that's the one you can calculate. So let's say the T-bill rate is 5%. We often use the Treasury bill rate as a proxy for the risk-free rate. The expected return on the market is 11%, and Firm X's beta is 1.1. So it has a little more than average market risk. So we plug it into the CAPM formula for its expected or required returns and get 5% plus 1.1 times 6% comes out to 11.6%. So that's our method one. Use the capital asset pricing model and our expectations about market returns and the stock's beta to get the required rate of return or cost of common equity. The second way is our dividend discount approach. Now, a constant growth dividend discount model is constructed like this, where we take the next expected dividend and divide it by the required return minus the growth rate of dividends over time, which is assumed to be constant here. Well, if we rearrange that constant growth valuation, we come up with this equation right here. And the intuition of this equation is pretty straightforward. That first term is the dividend yield, the expected dividend this year over the current price. The second, the assumed constant growth rate of dividends and earnings and equity for this firm. So that should be the capital gains, the percentage rate at which the stock price is going to go. Because you only got two ways to make money from buying a common stock. One is the dividend yield, if any, and the other is the expected growth in the value of the shares. So that's all we're doing in this model here, is saying the required rate of return, or the cost of common equity of the firm, is the dividend yield plus the growth in the share price over time. Now that G we've calculated before, and you'll probably see it again, but we calculate the firm's sustainable growth rate as its return on equity times its retention rate. And remember that retention rate is 1 minus the dividend payout rate. Our third method, probably the most fun, we take the bond market yield and add a risk premium. Now here that risk premium is 4. It's typically used 3 to 5%. But this is based on judgment. It's quite imprecise. The good news is it's hard to be really, really wrong because of bad input data. We're just historically kind of looking at the premium that common stock has paid over debt securities of the same company. So as long as that's in the 3 to 5% range here, we'll be pretty close in our estimate using this bond yield plus risk premium method. Okay, our target weights. Here's a practice problem for you. Which of the following methods for estimating the weights for calculating a firm's weighted average cost of capital is the least acceptable? So I'll give you a second to decide on one of these answers as your favorite. Well, our least favorite there is going to be answer A. It says current proportions of debt and equity based on balance sheet values. Well, even if we're using current proportions and not making any adjustments at all, we still want to use market values, not balance sheet values. Cost of capital for a project. Now, the learning outcome statement for this one, because you may wonder right away, how much of this do I have to know for the exam? Well, the learning outcome statement here says, calculate and interpret the beta and cost of capital for a project. So I'm assuming this is what that refers to. We calculate the cost of equity for a project. We can use the pure play method. So let me set this up. We've got a firm that's in one line of business. Okay, they make flags. And then they decide, well, we've got some land over here that may have oil under it. We think we should drill an oil well. We got to raise some money for that. Let's estimate the cost of capital for that project. Well, since it's so different a project from the rest of our firm, what we can do is go and find a firm that's in that oil drilling business. and look at their risk. This is called the pure play method because we're trying to find a firm that purely operates in the area of the project that we're considering. So we calculate the cost of debt for the company and then calculate the cost of capital for the project using the debt-equity ratio of the subject company and the weighted average cost of capital formula. So here's the steps. We find this pure play company, we get the beta of its equity. But now the beta, or systematic risk of its equity, is going to change with its amount of leverage. And so since our company may have different leverage than the other company, what we do is unlever that beta to what it would be if the company were all equity. And then we re-lever it based on how much debt we have in our company's capital structure. That gives us the beta for the project. Then we use the capital asset pricing model to get the required rate of return given that beta. And then we plug that in to the weighted average cost of capital formula and call that the weighted average cost of capital or the marginal cost of capital for the project we're evaluating. So let's go through those steps one more time. Calculate the beta of a comparable company or some companies, some group, that is a pure play in the industry we want to examine because that's where our project is. Then unlever this beta to adjust for differences in debt to equity ratios. This is sometimes called the asset beta. And then re-lever it to reflect the debt equity ratio of our company. And that gives you the project beta. Now, as you'll see, excuse me, as you'll see, we're also going to have some tax rates in here. Then we use that project beta to calculate the cost of equity for the project and use that cost of equity to calculate our weighted average cost of capital and then use that weighted average cost of capital to evaluate the project. Now here's our formula. We've got 1 minus the firm's tax rate times its debt to equity ratio and 1 plus that, all in the denominator. So this takes our beta for our pure play company and unlevers it to give us the asset beta. So when we're unlevering, we're using the pure play company's tax rate and the pure play company's debt to equity ratio. Once we get that asset beta, we can turn around and use our company's debt to equity ratio and our company's tax rate and re-lever this beta. So we take the asset beta, now instead of dividing by that term in brackets, we're going to multiply by that term in brackets, and that's going to be our project beta. Okay, I guess one last thing. Then what do we do with that one more time? We use that project beta with the capital asset pricing model to get a required rate of return on equity for this project, and then we use that instead of the firm's current cost of equity to calculate the weighted average cost of capital for that project. So if it's more risky than our usual projects, we'll calculate a higher required rate of return. Now, country risk premium. What's the problem we're trying to solve here? Well, the capital asset pricing model is problematic for estimating project cost of equity in developing markets. So we should add a country risk premium. So you see, when we used the capital asset pricing model before, and I guess this should be KCE, right? Required rate of return on common equity. Risk-free rate plus our measure of systematic risk beta times the market risk premium. Difference between the expected return on the market and the risk-free rate. Well, when we've got a project in a developing market, you should add a country risk premium right here. You won't have to calculate what that is. You just need to know where it goes and how it's used in calculating our required rate of return or cost of capital from expanding into a developing market. Now, the way I read these learning outcome statements, it says explain the country risk equity premium in the estimation of the cost of equity for a company located in a developing market. So I don't believe you're responsible for this calculation. And in fact, this is just one way to estimate a country risk premium. And in order to use this method, we have to be looking at a country that issues sovereign bonds, government bonds, denominated in another currency besides its own, in some developed market currency. For example, US dollars, euros, yen, pounds. So if we have that, then we can calculate this as the sovereign yield spread to US or whatever developed country we're using. So the sovereign yield spread of that country's issue to the developed country's issue, and then we're going to adjust that for relative volatility. We're going to multiply it by the annualized standard deviation of the country's equity index over the annualized standard deviation of these sovereign foreign bonds that are issued in developed market currency. So our volatility adjustment is risk of equity to risk of sovereign bonds. So we're going to take the sovereign yield spread and we're just going to scale it up by this ratio of equity volatility to bond market volatility. We'll take a look at an example just so you understand how we're using this. We've got a Brazilian 10-year US dollar bond that yields 9.2 and a 10-year US Treasury bond that yields 4.7. We'll match up the maturities here, and here's our yield spread, right? What is that? 4.5%, I guess. Now we need to adjust this sovereign yield spread for the relative volatilities. The annual standard deviation Sao Paulo equity index, 34%. Annualized standard deviation of Brazilian 10-year US dollar denominated bonds, 18%. The beta of our project's 1.32. Expected return on the market's 10% and the risk-free rate's 4. So now we can calculate that. Remember where we want to insert this country risk premium. We calculate that country risk premium as 8.5%. Here's our market risk premium. This is the expected return on the market minus risk-free rate. And here's our beta. So we add our country risk premium right here to the market risk premium and then crunch the numbers and come up with a cost of equity, 23.14%. Now, we talked before about the marginal cost of capital and the cost of each source of capital increasing. So the result is our upward sloping marginal cost of capital schedule. So now I've done it here as a step function so you can see, well, the first project, here's its cost. And the second project, we'd be investing this much. So we've got our project IRR and our weighted average cost of capital, and we're going to do every project for which the internal rate of return is greater than the weighted average cost of capital. Another way of saying that is we're going to do our positive net present value projects. So we've listed the projects from the highest yielding projects down to the lowest yielding or lowest returning projects. And then we've drawn this marginal cost of capital schedule going up at certain points where the costs of one of our component costs of capital goes up. And these are called breakpoints. So here's how we calculate those breakpoints. We're trying to find the amount of new capital investment for which the WACC increases because the cost of one of the components has increased. So if we take the amount of capital at which the component's cost of capital changes, divided by the weight of the component in the capital structure, that'll show us our breakpoint. Because remember, our breakpoints are on a graph on which the horizontal axis is our total investment in new capital projects. So this can include debt financing, common equity financing, and preferred stock financing. So if we're told that the cost of debt increases if we borrow more than $1.5 million over the period, and debt is 30% of the target capital structure, our breakpoint, where that marginal cost of capital schedule jumps up, is going to be at $5 million. Another way to look at it is if we're going to invest $5 million in projects and we're going to finance that 30% with debt, well, of that $5 million, we've got to raise $1.5 million in debt. So if we raise any more of that, if we raise any more than $5 million, we've got to raise more than $1.5 million in debt, and our overall weighted average cost of capital jumps up past $5 million. So that's our break point right here. Flotation costs, and how should we account for them? Well, flotation costs are the fees charged by investment bankers when a company goes and says, well, we want to issue some bonds or we want to issue some stock. And it ranges from 2 to 7%, higher for equity issues, less for debt issues. Now the CFA curriculum very clearly tells us that the wrong way, the way I did it and taught it for years, the wrong way is to adjust the cost of equity for these flotation costs. The CFA text argues that cost is incorrectly carried through the whole life of the project, or beyond the life of the project. The right way, they say, is to adjust the initial cash outflow to include flotation costs when computing net present value. So whatever those flotation costs are in dollars or euros or whatever currency you're working in, just add those to the initial outlay so that the initial outlay is greater by the amount they had to pay the investment bankers, the underwriter, in terms of flotation costs. And our last slide here is a problem for you to. At the beginning of last year, Acme had equity of $2 million, and a share price of $15. For the year, the net income was $200,000. Dividends were 30 cents a share on 200,000 shares outstanding. What's Acme's cost of equity capital? So let me give you just a minute to wrestle with that. Well, it's pretty clear we're not using the yield on debt plus a premium approach. And I don't see anything in there about beta or the risk-free rate or the expected return on the market. So we must be using that second method, dividend yield plus expected growth. So let's see how we do that calculation here. Our growth, as we know, ROE times the retention ratio. Here, our ROE is $200,000 over net income, $2 million, over equity is return on equity. The next component here is 1 minus the $0.30 dividend, 200 shares outstanding. So what we have here is the payout ratio. 1 minus that is the retention ratio. So we've got the ROE times the retention ratio. So now we come up with 7%, and that's our cost of equity capital. No, that's our growth rate. We've still got a bit to go, don't we? Now we can take the 7% as our growth rate and add that to our dividend yield. And that'll give us our cost of common equity. So a little bit of a convoluted problem, but tried to bring in several of these concepts to show you how they could be used or how they might be presented in testing your understanding of how to calculate the cost of capital or the cost of some of the components of the capital that the firm raises to fund itself.